Our attention now shifts to the other side of the transaction and we focus on lessors and the accounting requirements of IFRS 16, AASB 16 for accounting for leases for lessors. To guide us through this part of the accounting standard, I'm going to ask you to think about two distinct types of transactions. One is the lease of a substantial asset for a substantial period of time, so for example a large aircraft, and the other is a short-term lease of a small asset, a rental car. The issue is that from a lessor perspective, these have fundamentally different issues. And this is recognised right at the beginning in terms of accounting for leases by lessors. And paragraph 61 requires that a lessor shall classify its leases into operating leases or finance leases. These are distinguished on the basis of where the risks and benefits incidental to ownership of the asset lie. If they are effectively transferred to the lessee, then it's going to be classified as a finance lease, whereas if it's retained by the lessor, it's an operating lease. So in terms of those transactions I talked about less than a minute ago, would say that if you have a long-term lease of an aircraft, it's probably going to be classified as a finance lease, and a one-week rental of a car is probably going to be classified as an operating lease. The real issue here is that a finance lease is essentially a financing transaction where the lessor retains little interest in the asset, whereas an operating lease is a short-term arrangement whereby the lessor really does retain the asset, and it's simply a short-term arrangement whereby a temporary use of the asset is granted to the lessee. They have quite different accounting implications. In relation to finance leases, the issues are pretty straightforward and there's never been much doubt here. If you think about it from a lessor perspective, the lessor does not want to own an aircraft, they want to own a finance receivable, and they structure the transaction to ensure that that's the case. And paragraph 67 says that at the commencement date of a lease, a lessor shall recognise assets in its statement of financial position that represent the finance receivable, the lease receivable, at an amount equal to the net investment in the lease. And the net investment in the lease is the gross investment of the lease implicit in the discounted at the implicit interest rate in the lease, and this is the sum of the lease payments receivable by the lessor under a finance lease and any unguaranteed residual. Subsequent to that initial measurement, for a finance lease, the lessor shall recognise income over the term of the lease based on a pattern reflecting a constant periodic rate of return on the lessor's investment in the lease. So what we're effectively saying there is that you use that implicit interest rate to determine the interest revenue on the finance receivable. And this looks very much like one of these present value type tables again. And you can see that we have here 5 lease payments of 25 million or thereabouts. Discounted at 8%, it has a present value of $100,000. And you'd recognise $8,000 worth of interest in the first period, and $17,000 would be a principal reduction. It is recognised that modifications are possible, although in relation to finance leases it's less problematic because for finance leases the financier typically wants it just to be an extension of the lease or a modification, in which case it's most likely to be accounted for as a separate lease. And the accounting for this is just as you'd account for a normal lease, so it's pretty straightforward. So if you think about the lessor accounting, you'd say that what I'd call the anti-avoidance provisions are much less developed than they were for lessees, where the lessees have been trying to avoid the requirements of the standard for much longer. In relation to operating leases, we just need to think about the nature of the transaction. You have a car rental company who rents the car to someone for a weekend. At the end of the day, they still own the asset. So and they have the benefits of the asset. So at the end of the day, what we need to recognise is that the lessor retains the asset, and they simply get lease payments, and these are accounted for on either a straight line basis or another systematic basis, which reflects the payments made pursuant to the operating lease. So what we're talking about there is the lease expense method. For an operating lease, because the lessor retains the asset is of course going to be subject to depreciation. Focusing on property, plant and equipment, this will be done in accordance with AASB 116 and IAS 16. And it's also going to be subject to impairment, and this will be done in accordance with IAS 36, AASB 136. The disclosure requirements are, well, not that very extensive, but they are outlined in paragraph 89. These are quite specific in paragraph 90 in relation to finance leases and for operating leases. Accounting for leases by lessors has always been much more straightforward, as the lessors have historically had incentive to account for them in a way which reflects the economic reality of the circumstances.